Two.
Hi, everyone, and welcome to today's event. I'm excited to have two friends of mine who are among the best investment bankers in the tech industry, John Scuorzo and Zaheed Kajani. John and Zaheed are senior managing directors at Evercore, one of the top media and investment banks. Over their 20-year career, they've advised clients from Yelp to Upwork, Trade Desk, Roku, and my former company, Zillow. In fact, they were the lead bankers on the Zillow IPO. They did several follow-on equity offerings for us, convertible debt offerings. They advised on several M&A transactions. And so they've been my investment bankers at Zillow for many years. And more recently, they helped sell Grubhub in a highly publicized sale to Just Eat for $7.3 billion. That was the largest deal announced during the COVID quarantine and the largest US internet deal since 2014. So they are the real deal among the top tech investment bankers, and we're very lucky to have them today to talk about what's happening in tech and Wall Street. So thanks, guys. Welcome.
Thank you, Spencer. Thanks for having us.
So let's start with the capital markets and have you try to explain to me and to our listeners, why on earth is the stock market trading at, according to some indices, an all-time high? It basically has almost fully recovered or fully recovered on some levels from the downturn when the economy seems to be in such terrible shape. Explain that disconnect.
Yeah, and look, I think a lot of people who don't follow the markets every day have those same perspectives or same observations. I mean, look, I think the biggest and probably the most important driver of this is just the massive stimulus that all the central banks globally have put into the economy. There's somewhere where this money has to go. You know, if you got more money chasing fewer assets, it drives price up. That's kind of, the simplest way to say it. And you had basically every central bank in the world. I think our research, ISI, Evercore Research, keeps track of how many stimulative acts have been announced globally. And it's something like 500 announcements from central banks around the world. So that's kind of the most important element that's driving the stock market
so just
to the highs.
Governments have flooded the market. So the U.S., what was it, $3 trillion was the U.S. stimulus, and that money
so far
and that money goes somewhere, and it's going into equities. What about interest rates being so low? What impact has that had on the equity markets?
So that's the other element I was going to get to, right? So with interest rates so low, it's moved, people generally have an allocation towards equities and to bonds. And because the rates are so low, your bonds just don't give you the same return. And that's driven even more capital into the equity markets. The third element, which is similar, is if you're looking for, and then this is more respective for the US markets, is if you have capital in Europe or in Asia, which other market do you feel is the most stable and the safest market, right? And so many people who follow the market closely, you often see the futures up every morning when you wake up. A lot of that money is coming from overseas capital that's entering the US market. So you've got the central bank money, you've got money transferring from the fixed income market to the equity markets, and then you got international capital also flowing to the US markets. And so all of that combined is driving, these valuations and this trends. And then obviously the optimism regarding vaccines that's expected, that's also driving that. You've got all this money in the market. The Fed has basically said they're going to keep doing this. And if a vaccine solves it, you have the benefit of economic growth again, and you've got all this money in the system. That's going to take time to work its way out.
The axiom "don't fight the Fed" is sort of what we're seeing, which is they have an unlimited firepower, and they're going to do everything, at least till November, that they can. The federal government's going to do everything until the election to prop up the stock market. So okay,
I don't think they'd say prop up the stock market, but certainly support it.
Support it.
But yeah, absolutely.
Go ahead, John.
And I was going to also add, look, we just came out at Evercore with our perspective around the economy. It's our view that we experienced the sharpest and shortest and deepest recession on history. We think the economy is going to contract 10%. That's 2x the contraction since the Great Recession. But that said, our data suggests that we exited the recession in May, and we're back to an expansionary period. Though the cut was deep, I think the trajectory now is more positive than it was, and so it's off of a low base. But we think we're moving in the right direction with the economy only, we estimate 35% reopened.
Tell that to the 40 million people that have lost their jobs.
I mean, that's the other element, which is unfortunately, I think a lot of companies have realized they're being as productive with fewer people and using technology, right? So I think that actually may increase profits at the expense of maybe, as you said, a lot of reductions of headcount.
So that's
that people are looking at.
I think that's really interesting, which is, the way everything you said about asset allocation, moving towards equities and flow of funds, that makes perfect sense to me. But at the micro level, at the company specific level, in theory, the company stock price today is the discounted cash flow of future profits of that company.
That's right.
And a lot of these tech companies, the high growth tech companies, they trade a couple years into the future. So, if you take like whatever, Netflix or whatever, Snapchat, it's going to trade off of 2023, 22, 23, 24 earnings. And a lot of these companies have taken huge costs out, mostly headcount and marketing, over the last 3 months. And so if you believe the 2023 revenue for whatever, Snapchat, is going to be the same, that forecast is the same today as it was, say, 4 months ago, because we'll be through whatever downturn we're in now. But the margin structure of the company is going to look a lot stronger because they're going to have less headcount, less advertising, less operation expenses. Then actually, in some weird way, the stock should be higher than it was 3 months ago, because 2023 profit or EBITDA or whatever profit metric you're going to look at is going to be higher than it was forecast to be a couple months ago. So is that also what's happening?
I think there's some element of that. And also you didn't count the fixed costs, right? I mean, your former company said they're going to have people work from home. Yeah. And all of a sudden your office cost can come down, which, as you know, is one of the largest expenses. It's people and space. At the end of the day is where a lot of the expenses are. And so I think there's some of that in there for sure, especially as companies are realizing how productive they've been through this downturn. And then the last point I would say is just the acceleration of the technology trends that were already happening, right? Just the digitization that was already in effect just got accelerated significantly. And all of that adds more efficiencies to companies' operating capabilities.
So then you also have this kind of math problem, or not problem, but this math thing, which is the impact of the discount rate. Yes. As well, right? So maybe, John, can you explain what that is and what it means to stock prices?
Certainly. So as you laid out the Snap example, if we were going to back up the calendar 6 months ago, as you discount back that future revenue and earnings stream in 2023, a key input to discount rate is where else can you allocate your capital. So when rates are higher, that means the discount rate is higher because your hurdle rate is higher versus other potential investments. Now that interest rates are brought down to zero, it lowers your discount rate. And with a lower discount rate, corporate finance theory says future cash flows are worth more. So your scenario that you painted is exactly articulating the value of lower interest rates as it relates to asset prices.
It must be maddening to the average American who doesn't own any stocks, who just lost her job and, or had hours cut back, to turn on CNBC or open the newspaper and see stock prices where they're at when the real economy feels so weak to them. But I understand, you've explained really well why it is, but it's very dissonant to a normal person. Yeah. So let's talk about the IPO market. People talk about the IPO window, which means, is it an opportune time to go public? The IPO window, surprisingly, seems to be quite open. Companies are going public even during quarantine. Can you talk to that?
Yeah, I'll take a step back. Just going back a couple of months here, as we saw the equity markets rebound, we saw a surge in capital raising, and the markets have demonstrated tremendous resiliency and depth. May, we saw record equity issuance. So $73 billion of new capital was raised in the month of May. That's an all-time record. And despite this high volume of issuance, the offerings are being well received by investors. And it's our analysis that there's still a lot of cash in the sidelines, to Zaheed's earlier comments. Initially the capital raising that was occurring was very defensive in nature. Think airlines or restaurants during the shutdown needed to raise capital, essentially rescue finance. That quickly turned to opportunistic capital raises. And so what we saw were companies taking advantage of this rebound in their stock prices for already public companies to raise capital to enable them to be more offensive during the downturn. Tech companies were huge participants in this opportunistic capital raising. Many tech companies access the convertible market, for example. In Q2 alone, to date, we've seen 36 technology converts raise $25 billion of capital.
Wow.
Compare that to all of last year, 2019, 50 converts raising 30 billion. So we almost did all the volume of last year in the second quarter, similar in the follow-on market. And so it started out with the rescue finance to opportunistic capital raising in the various markets, and then it slowly turned to the IPO window opening.
Before we get to IPOs, John, so there was a Wall Street Journal article the other day about this, about how companies have raised so much cash over the last couple of months. This is obviously a very generalized question, but what are they going to do with all of this cash?
Yeah. So they're going to press their, competitive advantage. So to the extent, they've got opportunities to invest organically in the business, it gives them that flexibility to do so. To the extent there are smart strategic acquisitions they can make, it gives them the ability to do so. And so what I think everybody realized during the downturn is how strategically important cash in the balance sheet is.
Mm-hmm. Okay, so IPOs, how many IPOs have happened during quarantine?
So during quarantine, we've seen 30 tech IPOs price since quarantine.
And when this happened, at March 15th, how many IPOs would you have guessed there would have been? Surprising to you?
Yeah. So look, the reality is when you look at the IPOs that have come to market, about 2/3 of them have been healthcare companies, which obviously are net beneficiaries of the backdrop and insulated from everything that's going on. But what we started to see is a broadening out of the IPO window. And so, for U.S. companies, we've seen 4, broadly defined tech companies access the market. That's SelectQuote, ZoomInfo, Vroom, and Shift4. Mm-hmm. All these IPOs were very well received. They all priced above the marketing range and have all traded very strongly in the aftermarket. The average tech IPO is up about 85% since pricing in the last couple of weeks.
Now, when you guys took Zillow public with me in 2011, we did a traditional IPO, a roadshow where we flew around the country and met with investors. It was a 2-week process, very time-consuming and energizing and stressful and fun and et cetera. These IPOs are being done all by video conference.
By video conference, Zoom meetings.
And do you think once we're on the other side of COVID, we're going to return to in-person IPO roadshows, or is this the end of the roadshow and we're going to be all video all the time for now?
Yeah, it's a great question. Look, I still think there is benefit to meeting companies. Investors want to meet you face to face. They've had to do without in the current environment. But I think that going forward, it's going to be a hybrid model where we, take advantage of the efficiencies that are created by being able to do, 40-minute, video conference calls back to back during a day, and rather than having a company take a week and a half of market risk, shorten it to 4 to 5 days of market risk by doing both virtual and in-person meetings.
Now, it's important to remember some offerings were always done by conference call, really, right? Like convertible debt offerings, for example, were not done with in-person roadshows. So this isn't unprecedented. It's still kind of surprising to me, though, that these roadshows are going off without a hitch, completely by video. It is an interesting case study. If you take a step back outside of the investment banking conversation and just think about permanent impact to the economy from COVID, if investment banks don't have to travel to do financing roadshows, well, that's a decent amount of travel that comes out of the economy. Now multiply that across all sorts of other industries of, sales calls and consultants traveling, et cetera. Do you think that at Evercore, there will be a permanent step down on travel? Zaheed, you were on the road, 300 days a year historically? What will it be in 2021?
Yeah, look, I actually don't think it'll be, I think we'll kind of get back to some more of what it used to be, because I think what you find is new relationships are hard to build through video conferencing, right? A lot of these companies had met with many of these investors previously, prior to COVID. They're all thinking about going public, as you know, and there's testing the waters and conferences, et cetera. I did the whole Grubhub deal from my couch, right? But these are relationships that I had in advance. I think what we're finding, and we're seeing that in certain Series A capital raises right now, is if you have no prior engagement or relationship, it's hard to do an entire deal without that. There's still that human touch. You're trusting the management team. You're investing in them in many of these situations. So I think there'll be certainly much more efficiency. Now, people who weren't willing to do it are going to be more willing to do it. That being said, I think it'll probably be something in the middle. It won't be as extreme as it is now, but I think it'll go back, because these are all relationships that had been built prior to COVID and essentially got monetized during it.
Yeah, that's a good point. And I had somebody, the head of sales at a big software company, said to me something similar. He said, I'm going to still have to travel, because if I'm not there selling to a CTO in person, my competitor will be. Exactly. And as an investment banker, I'm sure you feel the same way. If you're not there pitching a client in person, your competitor investment bank is going to be as well. So that's building those new relationships, you're still going to do in person. Let's stay on IPOs for a second and talk about the traditional IPO process versus direct listing process. So in a traditional, actually, first of all, maybe John, you can just explain the differences between the two, and then we can talk about pros and cons.
Sure. So look, the direct listing that got a lot of press last year was really all the talk within the tech ecosystem. I think that this year there's the market distraction has caused that to die down. That said, I think the strong performance of some of the recent IPOs has reawoken the VC community, with prominent VCs like Bill Gurley at Benchmark, really strong proponents of direct listing. The difference between a direct listing and a traditional IPO, the reality is the process is almost identical. There is investment banker due diligence, there is an S1 filing process, there is SEC review, and there is a roadshow where you go, and whether it's virtually or in person, go and tell the story around the company's positioning and outlook. The key differences between a direct listing and a traditional IPO is, in a traditional IPO, you can raise primary capital.
What does that mean? What is primary capital?
Primary capital is the company sells shares and brings cash into the business to help it, fund its growth going forward. So it is a capital raising event. In a traditional IPO, because you are selling shares, you ultimately curate your shareholder base by an allocation process. So the 10 million shares that company XYZ is selling to raise capital, they, along with the banks, hand out those shares to the investors that they met during the marketing process. And, the companies typically like to have a say as it relates to who their investor partners will be going forward. In a traditional IPO, in addition, some of the pre-IPO investors sometimes are offered the opportunity to sell in the IPO so that they can sell a portion of their stake along with the company. But in technology, that's typically not the case. But what is the case is that all pre-IPO investors and employees in a traditional IPO are locked up and prevented from selling in the aftermarket for a period of time. The typical is 180 days. Compare that to a direct listing. In a direct listing, the primary rationale for it is to get improved price discovery, meaning
don't leave money on the table, if you will.
Correct.
Okay.
Eliminate those first day pops, and two, provide immediate liquidity to all investors.
Because there's no lockup period.
There's no lockup period. So just to go on both of those topics. So because there's, in a direct listing, there isn't a mechanism currently to raise primary capital. So you can't raise new funding alongside a direct listing. There are people trying to figure out a way to do that within the SEC framework. Because there is no capital being raised, there's no predetermined IPO price, and you don't have that process whereby you handpick your investors. So you don't have the allocations. It's a more democratic process. And what that means is that all investors are free to either buy or sell the stock in the market without restrictions. So pre-IPO investors, employees, they aren't locked up. So on the first day of trading, when the stock starts trading, they are free to sell or buy to the extent they wanted to. And any institution that's interested in the company is free to go into the market and buy their desired position investment in the company alongside of everybody else. And so what that results in theoretically is price discovery that's purely market driven. It isn't judgment, by the investment banks and the company as it relates to where to price the IPO and where to see it trade in the aftermarket.
So companies that have done direct listings, tech companies include Spotify and Slack, among others.
Correct.
And to summarize, they don't sell primary shares in those direct listings, meaning the company doesn't get any proceeds. But their shareholders have immediate liquidity, so they can start selling in the aftermarket right away. There's no lockup period. And the price is what the price is. There's no pop because they're not selling any shares at a particular price. So Bill Gurley, who was on my board at Zillow for many years, has made this a personal mission to try to persuade tech companies to not list traditionally, to instead use direct listings. And in particular, he rails at the pop. In the case of Zillow, if I remember correctly, I think the range on the prospectus was like 12 to 14 or something. And then we increased it to 14 to 16 based on demand. And then we ended up pricing at 20. And I think the first trade was at 60 and it closed at 38 or some such thing. So, and Bill was on the board at the time. And so Bill would, on the one hand, the media says, oh, great IPO, well done, Zillow. On the other hand, you could very well argue that, hey, we sold shares at 20, which then closed that day at 38. So we left a lot of money on the table. And instead of raising $100 million in the IPO, Zillow should have raised $200 million by pricing it at 38. So what do you say to that? What do you say to those that say, don't leave money on the table, instead do a direct listing?
Yeah, so let's just take a step back. Our view is that we think that both avenues to getting public are viable alternatives for companies. Companies should choose the direct listing or IPO based on what best achieves their objectives. And right now, the primary fork in the road is whether or not you need to make the IPO a capital raising event.
Okay.
To the extent you don't
do you
it,
need the money? Basically, Zillow did need the money, but Spotify did not. So Spotify didn't need the money. So a direct listing might be more appropriate in that case.
So you're correct. And so I think where there's a lot of discussions with us currently, and as we're talking to companies, is how do you, evolve the traditional IPO to better achieve objectives and not leave as much capital and money on the table. And there are alternatives to get more efficient execution. One of the interesting things is that as, for years, IPOs have traded up, 30% on average day one. It sort of becomes a vicious circle because stocks are going to trade up 33%. So the VCs don't want to sell at the time of the IPO because they don't want to take that 33% discount. They encourage the companies to minimize the primary component to minimize dilution because it's going to trade up. And then what happens is that you get well oversubscribed and you have all this investor demand and then it drives this initial pop that's really a somewhat of a more supply, more demand to buy the shares than supply. It's almost a short squeeze. And so when we talk to investors, they also believe that there's room for improvement in IPOs. And what they talk most about is improved liquidity. And so to the extent we can find a mechanism that matches supply and demand and liquidity better and price, we think we'll get better outcomes. So modifications, for example, are a variable number of shares that are offered that as IPO price goes up, the number of shares, for example, that are offered goes up. And those shares could be additional primary shares, or they could be shares that are coming from existing investors.
Can you does the SEC allow you to do that? Can you actually have a
there are mechanisms.
Okay. Besides the ratio.
Yeah, there are mechanisms to do that, and we've actually done it in prior IPOs Zaheed and I had, where we're able to toggle that. The other thing around liquidity is, are there alternatives to modify the lockup agreements and let investors know that there's going to be more supply that comes to the market that sort of reduces that fever that institutional investors are struck with, because from their perspective, they realize that in an IPO like Zillow, you basically have 2 days of liquidity. And within those 2 days, you either buy your position when there's liquidity in the market and there's a lot of trading, or you sell your position because you'll never be able to buy it once that liquidity dries up. And so to the extent you can assure investors that that liquidity is coming sooner, it should help to facilitate more efficiency.
And Spencer, one way we solved it, if you remember at the Zillow IPO, is we did a small IPO.
Yes.
And we came back and said, because look, there's also a branding event of the IPO. And if the press and everybody looks at a big pop as a positive, we wanted that too, especially when a brand is not as well known. And so the way we solved it at the time was a very small IPO and then come back and raise money at a higher value and much, our follow-ons were about 4x the size of the Zillow IPO.
Yeah, and that was how I always kind of, and one of the questions that came in through the chat was that, which is why not just do a small IPO, which is what we did at Zillow and what OpenTable did and, what some others have done. So, I mean, I think, the IPO, we sold shares at 20 and then we did a follow-on probably in the 40s and then another follow-on in the 60s. By the way, the stock has split 3-for-1 since then. So if you're wondering how this equates to current stock price, you have to divide everything by 3. But anyway, and I look at those 3 offerings together, the IPO, the first follow-on, the second follow-on, which in total we raised, I don't know, 400 or 500 million at like a much higher blended price than the initial IPO. So that's kind of how I rationalize the did we leave money on the table issue. But the fact is, if we hadn't needed the money, then perhaps we would have done a direct listing. So, and it's great that alternative is out there today, and it wasn't really as accessible.
And also the other thing you have to remember is the awareness. The awareness of these companies wasn't as well known as things are today. You have a testing the waters process now. You have public investors investing in private companies. That wasn't the case, until almost 5 years ago. Really, after the Alibaba IPO, is where you had all of a sudden you had a lot of crossovers investing in these private rounds and companies staying private much, much longer.
Yeah, so this is
getting
like
to know these investors.
So Coatue, DST, T. Rowe Price, Durable, Tiger Global, like these firms didn't exist really 10 years ago, or they were much smaller. And now those are available to do like the Airbnb round that Airbnb just did privately, which pushed the IPO out. One of the questions that came in through the chat is, what impact do you think COVID will have on this direct listing kind of traditional IPO debate, if any?
So maybe I can start. I mean, look, remember, a lot of these companies need the capital, right? Especially during COVID. I mean, that's, everybody's kind of nobody knows, is there going to be a second wave? What's going to happen? It's all still early from that front. And if you listen to Chairman Powell's comment, he still thinks it's going to take a while for things to come back, despite the V recovery in the stock, if you will. So I think most of these companies want the primary capital, which limits the whole direct listing option currently.
And last question on direct listings: why haven't we been able to devise a way to raise primary capital in a direct listing environment? Like, what's so hard about, you just do a direct listing and then once the price has settled, then the company sells primary shares directly into the market in some sort of an online mechanism. So there's no allocate. You're not handpicking the allocation to investors. It's just sold into the marketplace.
Yeah. So look, there's been a lot of work that was done in the prior direct listings. The conversations with the SEC are ongoing. Right now, there is a period of time, at least 90 days from the direct listing to the time when the SEC gets comfortable as it relates to the company can go and raise primary capital. Because
they require a 90-day waiting period post direct listing before you can sell primary shares.
That's the current guidance. And so, so that's the, look, you see the NYSE that's out there trying to devise mechanisms. There's a lot of people that are trying to work on how do you marry the two. And I believe it's just a matter of time until we find a mechanism that works for the regulators, that works for companies and works for investors, so they can, everybody can see exactly what's going to happen from a primary capital raise and from a liquidity perspective.
Okay, let's talk about M&A. What is the state of tech M&A generally? And if you can give us some stats on that, Zaheed and John, and then I would love to just kind of layer into that conversation a discussion of regulatory and antitrust and what impact that has on M&A.
Yeah. So let's start with some facts, right? So, I mean, for the 5 months of 2020, global, and if you compare it to the 5 months of 2019, global M&A activity is down 42%. U.S. M&A activity for that same 5 month period is down 63%. Now, US TMT, or technology, media, telecom, which is how we often group these, it's also down about 40%. So not as much as the overall US market, but they're down substantially. So, look, volatility is hard. I mean, we obviously did the Grubhub deal, which was one of the largest, but that's frankly unusual in this time. That's why it's the largest deal through COVID, because when you have volatility, you're not sure what to judge. Your stocks are moving so much every day. It's certainly very hard to do a cash deal on a public side. Most of these are stock for stock, kind of my stock's down, your stock's down. So although they've all come back mostly, but when these discussions were happening, many of them started out much lower. So that's just hard for companies to make that type of decision. Two is, you're not sure if you're taking additional risk at a time when people are feeling maybe I shouldn't be taking so much risk. It's just a hard decision for a board to justify. In fact, we're actually seeing the opposite, right? So you're seeing deals that were done that people are trying to walk away from. So there was the Simon Property Group and the Taubman deal, which is two malls that combined. Simon Group tried to withdrawing from that deal. Right. You saw L Brands, which is Victoria's Secret, and the Sycamore, which is a private equity firm, they got out of that deal. There was the Tiffany's deal that also the party, one party's trying to walk away from. So, you're actually seeing somewhat of the opposite, where deals that were essentially done that our parties are walking away from, because especially if they're in retail and areas that are going to be, more damaged or more challenged in this, in a post-COVID world, we're seeing some of that happening.
I've definitely experienced that firsthand. The kind of in boardrooms, in boardrooms, companies and management teams are sort of shell-shocked and dazed and confused, and just trying to figure out, how am I going to survive? And the first instinct was cut costs, and they did. The second instinct was raise cash, and they did. And now it's manage through this crisis. And I think now they're increasingly turning to employee comms, kind of, how do I settle my employees so they're still motivated? And then you layer on top of that, Black Lives Matter happened sort of right around the same time. And management teams were struggling with how to talk about DEI and how to address these issues with employees. Not at the top of this list is M&A.
That's right. That's right.
It's like that can wait.
Yeah, absolutely. I mean, look, they're really trying to figure out what should they do. You're seeing the ones who are doing it are the tech companies who are have, as I said, their business is accelerated, right? If you look at, we sold a video conferencing company to Verizon called Blue Jeans during COVID. It's obviously a big video conferencing is, what we're all using right now is a big beneficiary. Food delivery, a big beneficiary of what's going on. So those who are willing to be offensive, if you will, are those who are confident of their existing business and see this as opportunity. Most of the others are a little more defensive right now and want things to settle down before they decide to take a big step forward. If you think about it, deals that were done prior to COVID may not, one may argue with the material adverse clause that, things have changed. We didn't expect the pandemic. Somebody who does a deal during the pandemic can't say, I wasn't expecting a pandemic to get worse. So, you also have to think about the risk reward, and that's what's causing M&A activity. But, we're seeing dialogue pick up for what it's worth. We're certainly seeing dialogue and activity level pick up.
I would expect that, yeah.
But it hasn't gotten to the point of large announcements yet.
So a lot of the people that are listening to this or watching this that run startups, they hope to either go public someday, but they realize that their company might not be big enough to warrant a standalone public company, but they hope probably to sell the company to a tech giant. And increasingly FANG, Facebook, Apple, Amazon, Netflix, Google, they have more and more market share. It looks like they're going to come out of COVID even bigger and badder than they went in. And yet they're also under a lot of scrutiny from the government for their size and for privacy practices and for, alleged monopolistic activities and behaviors in certain areas. So how should startups, if you were prognosticating on the M&A attitude and energy among those biggest tech companies for startups in the, say, 100 million to $1 billion M&A exit range. Like, how should those startups think about those big acquirers, over the next couple of years?
Yeah, look, so you're absolutely right. There's a bigger and bigger focus on the FANGs, if you will, from politicians, regulators, especially in Europe. It was more aggressive in Europe, and now, much more in the US. Historically, the smaller deals were less of a focus because they looked at kind of standard antitrust issues, measurement tools. And most of the smaller kind of sub $500 million deals didn't face that, although there's now been questions around even that, like, are they limiting people from progressing? Look, I think at the end of the day, look, even deals like T-Mobile got through. So our view is that politicians may weigh in based on whatever's relevant to the political environment at the time. But it's really, there are regulatory frameworks, there are ways you can work through the deals, generally speaking. There will be more scrutiny, but there's also a whole new set of large players, I just gave you one, Just Eat Takeaway, that probably nobody had thought of, right? And Uber is in the crosshairs as well, even though it's not as large as your FANG name. So I think if I'm one of those earlier stage startup, I think there'll be many, if it's a good company and there's interest, there'll be ways to make it work. Maybe it'll be the FANGs. Maybe they'll have to work with the regulators to get it passed. You went through some of that with Zillow, Trulia. You understand what that means, or others. So we think it's more of an issue for them, but for a startup, I don't see it as a major issue to impact their ability to do a sale, down the line.
Okay, and one other question, kind of on behalf of that cohort of viewers and listeners. Let's say you're running a Series B or Series C startup that has a couple, maybe 100 or 200 employees, and you hope to sell to Facebook, Uber, Amazon, Apple, et cetera, in 2, 3, 4 years. What should they be thinking about? What advice would you give to them? Should they be getting to know the M&A, corp dev people at those companies? Should they be networking with investment bankers? Should they just be focused on the business and building, the most valuable business they can? Like, what should they be doing to hopefully maximize an M&A exit a couple of years down the road?
Yeah, I mean, look, I would say first is there's no replacement to focusing on the business. I mean, if the business doesn't succeed, all of this is moot, right? So to me, the first place is make sure the business is succeeding and has the resources and the management bandwidth to do that. Most M&A often starts from business development relationships. So it's important I think it's good hygiene and good housekeeping for teams to have a corporate development person whose sole job is to go build those relationships and have an understanding of the business of the world that could be potential acquirers for them. There can be commercial agreements that can play itself out. But I think that's an important element because often what we find is deals that get done started from that corporate development relationship. Look, certainly bankers can be helpful to be almost an outsourced corporate development team to some level, especially with trusted bankers to help go mine what's out there, to understand the landscape, to be helpful to the corporate development teams or to the management teams of where they should spend their time, who are places they should build relationships, and frankly, just make introductions, et cetera. But ultimately, the strength of the business is what will make or break the deal. And that cannot be, I think that's lost sometimes.
So we talked about the difference between direct listings and traditional IPOs, which is a pretty technical conversation. I want to shift gears and move to an even more technical discussion, which is the topic of Spax, special purpose acquisition companies. Did I get that right?
You got it.
That's right.
Okay, so SPACs are in the news a lot lately. In fact, just today, Bill Ackman, who's a hedge fund investor, announced a $4 to $6 billion SPAC. A prominent tech investor and former Facebook executive named Chamath has done a number of multi-billion-dollar SPACs. So can one of you explain to our listeners, what is a SPAC and
Yeah.
why are we hearing so much about them?
Yeah, I'll take a first cut and Zaheed can add. So the other name for a SPAC is a blank check company. And so what does that mean? These are companies that go and raise capital via an IPO with the cash that's raised is going to be earmarked to do an acquisition of a company in the future, right? So raise cash, it's put into a trust, then the management team goes and tries to find a company to acquire, and they put that cash towards that acquisition. For the company that's getting acquired, it's effectively a way to get a backdoor IPO because the SPAC itself has no business, it's just cash. And so the stock that starts trading is a reflection of the business that gets acquired. To give you some perspective, you talked about Bill Ackman, but even before Bill Ackman, there are currently 96 SPACs that have been raised and are in the market looking for acquisition targets. These 96 SPACs have a combined $25 billion of cash sitting in trust.
Wow.
Right. And when a SPAC does an acquisition, they typically buy something that's 3 or 4 times the amount of cash they have in trust. And so that equates to the theoretical amount of $100 billion worth of companies that could go public just from existing SPACs.
Wow. And there, the other interesting wrinkle here is that SPACs have, by law, a 2-year time frame to complete that acquisition. And if you don't complete the acquisition within 2 years, then what happens?
Then it dissolves. They basically give the cash back.
And the sponsors, basically the person or people that created it, are out for the expenses and the cash in that they put in, which is usually, $5, $10, $15 million on top of expenses. So
yeah,
they have this ticking time bomb to complete a deal post the SPAC IPO. Yes,
that's correct. That's correct. But I think what we've seen, so beyond the Bill Ackman announcement, there's been 3, I'd say, there's been more, but there's been 3 very high profile successful SPACs just this year alone. So Nikola, DraftKings, and Virgin Galactic. The performance of these companies has been
all in tech or TMT.
Yeah. So Nikola, it's currently a $25 billion market cap, and from the time of the SPAC IPO to where it's trading today, it's traded up 550%. DraftKings similarly, it's got a $13 billion market cap. It's up 320%, and Virgin Galactic is up 50%. And so, in many cases, what you're getting here are companies that are relatively early stage. They get some of the benefit of having the SPAC sponsor, the person who raised the initial capital, like a Chamath, for example. Their validation, they're making the investment, gives some confidence to the public investors. And I think the takeaway for this group is given this recent success of the SPACs, given the amount of capital that's out there, just like direct listings are a viable option to consider, I think even more so, more recently, SPACs are also a viable option. And so any evaluation of future paths should include, the consideration around what the SPAC makes sense for you.
So a private company can sort of think of a SPAC as another way to go public, is what you're saying.
That's right.
Now, one person asks in the chat here, can you explain the difference between a SPAC and a private equity firm? So, I mean, the way I think of it is a SPAC is when an individual raises money in an IPO, and then that money sits there and has 2 years to do one deal. Whereas a private equity firm is a firm that goes out and raises a fund from limited partners, so from pension funds or high net worth individuals, and deploys that fund over 10 years, usually, or 5 to 10 years, usually in dozens of companies.
The other key point, though, Spencer, is that SPAC is public. So it's actually trading, right? So it's basically when the SPAC buys that company, that company is now, you don't go through the process you went through in an IPO. They're public by the back door. And basically people have trusted that sponsor, Bill Ackman, Chamath, and saying, look, we feel good that these people are investing in this, as opposed to a General Atlantic or whomever who does a private equity fund. They just basically have a private fund and make an investment in a company. It doesn't mean it's public. It's just they would have to then take it public through some direct listing or IPO.
Now, somebody asked in the chat, are there limits on the amount of leverage that SPACs can apply when they do their deals?
So look, it's ultimately the investors have the ability to vote on the transaction. So what the SPAC sponsor is required to do is to buy the right company at the right price with the right structure. And to the extent the investor doesn't agree with or like the company or the investment or the structure, they could basically ask for redemption of their capital that they initially put up. So there's no, the market is the judge as it relates to what are the boundaries.
One point, Spencer, just to be clear, there's not leverage and they're not taking on debt necessarily.
Right.
What they're saying is they're giving the cash. If I have $500 million in the SPAC, I can buy a $2 billion company because the other shareholders would own the remaining 75% into this new public company, into this new
They're issuing
entity.
stock basically, which is how they do a deal that's bigger than the amount of cash that they've raised.
So it's not debt. It's not leverage in the sense of debt.
So I've been pitched this many times, not by you guys, but by many of your competitors. Although we've talked about it casually. So we'll do something. This is unprecedented. We're gonna do like a live pitch on whether Spencer should do a SPAC. So the way it was pitched to me was, Spencer, you put in $5 to $10 million personally. We'll go raise you and like 2 or 3 other people. So it's not an operating company. It's just a couple. It's basically just a lawyer or 2 and an accountant or 2, take this company public as a SPAC, call it, Spencer's SPAC. And it would raise, I think it was suggested raise a $500 million SPAC, which could then go out and raise, go buy a company for 1 to 1.5 billion. So to the last questioner's question, basically 2 to 3x the amount of cash raised. So I'd spend the 2 years going to try to find a company. And by the way, the lists of companies that investment bankers present to people like me are basically unicorns, right? And there are a lot of LA companies on there. They're like, hey, let's go try to buy LegalZoom or ZipRecruiter or Headspace or these companies that might go public in the next year or 2, but they can go public in this way. And the pitch that I would make is, hey, whatever, LegalZoom or whoever, I'll become the chairman of this company. The SPAC will buy you. You'll become public, when the deal closes. And when I've identified that company, I have to go back to the investors that invested in the SPAC and basically tell them, so the people that bought the IPO shares say, hey, we're going to buy LegalZoom for $1 billion. What do you think? Are you in basically, or are you redeeming? Are you out? Do you want your $500 million back or whatever piece of the $500 million they put in? And if they're in, and by the way, if they don't like everything about the deal, they may renegotiate at that point and basically try to take away some of my promote, basically the extra that I got for doing the work. And as I said, if at the end of 2 years it's not done, then I lose the money I put in and I lose the deal expenses, which could be $5 to $15 million if I did a lot of due diligence on dozens of companies over those 2 years. So first of all, did I relay the pitch properly as you would have pitched it to a sponsor like me, or did I?
Yeah, I think you nailed it. And I think what's probably as interesting to this audience is then what value does a SPAC bring to them getting public, right? And so you hit on that, and I think that's where all the work begins once you raise the SPAC, which is going to that list of unicorns or whatever other companies that are on the list, and articulating to them the value that you bring as chairman. The mechanisms where you can go and raise additional capital, from other investors alongside of the announcement of the acquisition in pipes. And we've seen that with, Nikola, Fidelity, ValueAct, Schoenfeld all came into the deal alongside of the announcement. You have an opportunity to go with this management team, you and the management team, to tell a more nuanced story because it is a longer private marketing period. You're not out there with an S1 like in a traditional IPO. And so
why does the target, so why doesn't Virgin Galactic just go public traditionally?
So historically, Spencer, it was mostly companies who didn't fit the normal story, right? The people who went to SPAC, so I mean, look, so Virgin Galactic, like whoever thinks is it ever going to make, it has no revenue, is it ever going to make money? It's a high bet. You just bet on Chamath, basically saying, look, Chamath believes in it. I believe in it. He's done good at this stuff. Mm-hmm. I'm going in. So if you think about what's generally come through SPACs is kind of things that are non-traditional, right? DraftKings had a bunch of regulations in different states that still had to be passed, and you weren't sure how it was going to play out, right? The car company, the electric car company that's gone public has no revenue, but is trading at $30 billion.
So sort
Right,
of
like-
oddballs that might have a hard time going public traditionally.
That was that was what it was.
Okay.
But now that they've
Changing.
been so successful, and you have more people saying, you know what, this is actually a viable thing, maybe more of the better companies like the Zoom might think about it. But they don't get the branding event that an IPO does. They don't get to tell their story in an S1 like you did. And so most companies generally don't do that unless they have some other, they'll just go down the traditional path. Why give any promote to Spencer? He's
Right.
not adding much here. I'm good. I can do it myself. So
Right.
that's the argument. But there's a lot of money, and maybe they'll pay a little more than they should, and we'll see how all that plays out.
All right, let's wrap up with just talking for a moment about LA. What are some LA companies that you all are tracking, either public or private, that you think are interesting and are just showing a lot of potential? We've mentioned a couple, but
yeah, I mean, look, I think Trade Desk is one we've worked with. We think very highly of in LA. GoodRx is a private company that's really done amazing things on the pharmaceutical side. LegalZoom you mentioned. Age of Learning is another one. ZipRecruiter is another one that's done well in LA. So we actually spend more and more time in LA than we used to in the past, just because there's just a lot of innovative companies out there, and they're only increasing. As all these entrepreneurs do well in one company, they then seed more companies, and that's been great for us.
absolutely. And .LA is trying to tell their stories. So thanks, guys, for the conversation. I really enjoyed it and appreciate it. And thanks a lot, John and Zaheed. Be well.
All right, great. Thanks you, Spencer.
Thanks,
Appreciate it.
Spencer.
Thanks, guys.
Bye.
Great conversation.